we're going to be talking about different types of student loans, repayment options for student loans, forgiveness programs for student loans, if it makes sense to aggressively pay off student loan debt, and then what happens to different types of student loans if something should happen to you. So first of all, student loans are loans that you take out to go to school. When you don't have enough money to pay in cash, you get a loan. So there are different types of student loans that are available. There are federal and there are private. And so private loans are loans that come from a bank or a credit union where the terms are set by that bank or credit union, and it's based on credit worthiness. Federal loans vary a little bit from private loans. So there are 5 different types of federal loans I'm going to talk about. The first one is need-based, and this one is subsidized. So this has the lowest interest rates. It's available to folks who show some type of need for additional monies to help get to school. It's interest-free while the student is in college. And so while you are taking your classes, matriculating, there is no interest accruing. And the interest doesn't start accruing until after you graduate. There are unsubsidized loans. So the difference between subsidized and unsubsidized is when the responsibility for the interest takes place. So with unsubsidized loans, students are responsible for the interest while they're in school. And so while you're in school, you can have the interest payments deferred until later, but you're still responsible for the amount that accumulates while you're in school. There are federal plus loans. So this is where, let's say you need additional money for school. This is based off the cost of attendance and credit. So not just parents getting plus loans, that's the parent plus loan, but also students who are enrolled half-time or full-time can apply for federal plus loans. And of course, we have the parent plus loans, which a lot of our parents took out for us. Biological parents, adoptive parents, and step parents are eligible to apply for parent plus loans to help a student get through college. And then there are federal Perkins loans, which actually are no longer available. And apparently these were the best things going. They had the best rates. And there's a lot of opportunities for repayment options if you have a federal Perkins loan. So I'm going to talk about those in a second. Now, typically between federal and private loans tend to carry a higher interest rate. And essentially it's like, they don't care about you. I don't want to say it like that, but let's talk about the different types of forgiveness options. The one that's most common that a lot of people know about is public service loan forgiveness. And so this is 120 payments for 100% forgiveness of whatever is left over. Now, with the public service loan forgiveness, it's important to know that this is for it's more about the entity that you work for and not so much the job description. So if you are federal employee, state employee, local employee, or if you work for a 501c3, you might be eligible for public service loan forgiveness. And so you'll have to make 120 payments. They do not have to be consecutive. So this is a common misconception that it has to be 120 consecutive payments. Sometimes if there's something that happens, you might still be able to qualify. So if you work for a federal, state, or local or 501c3 organization and you think you might be eligible, definitely go check out public service loan forgiveness as an opportunity to see if you can have some of your loan forgiven. The one caveat to that is that if you work for a religious organization, so any churches or things like that, those do not qualify. So that's public service loan. The second one is federal Perkins Loan Cancellation. So if you have a Perkins loan and you got that loan after October 1st of 2007, you might be eligible for loan forgiveness in this program. And there are lots of different types of jobs that qualify. So if your If you are a teacher in a low income area, if you work in a child care program, community defender, if you teach SPED, if you were a nurse, firefighter, officer, law enforcement, if you served in a hostile fire area, if your college closed early, if you were a VISTA member in the Peace Corps, all of these are examples of different professions that qualify for the federal Perkins Loan Cancellation. So if you got a Perkins loan after October 1st, 2007, you definitely want to go check out and see if you qualify for this loan cancellation. Forgiveness: if you teach in a qualifying school for 5 consecutive years, you are eligible for varying amounts of loan forgiveness. So typically this is if you're serving in a low income area. So you can check to see if your school qualifies. Pretty much all elementary school teachers that do 5 years can qualify for up to $5,000 of loan forgiveness. If you are teaching a STEM subject or SPED, you might qualify for up to $17,500 of loan forgiveness. So if there are any teachers in the group who have been teaching for 5 years consecutively, this is definitely something that you want to check out. Just by the nature of the school that you're teaching at, you might qualify. And in addition to that, you might also qualify for public service loan forgiveness. So not only is it a great idea to check to see, okay, if I qualify for one of these, I might be able to qualify for multiple different types of loan forgiveness. One of the new ones, well, it's not new, it's new to me, that I just found out about was the Nurse Corps. So if there are any nurses who are RNs, nurse practitioners, or if I am a nurse that teaches in an accredited nursing program, I might also qualify for student loan forgiveness. And so I just have to be serving in an underserved community. And if I've done 2 years in that community, I can qualify for up to 60% of my student loans being forgiven. And if I've done a 3rd year, an additional 25% might be forgiven. So any nurses that are RNs, nurse practitioners, or if you are nurse faculty, this is something that you want to check in. So there's the Nurse Corps Loan Forgiveness Program. Then additionally, there are many state programs that are available, especially for other healthcare or health service providers. So pharmacists, there are programs available where you may get up to $50,000 of your student loans forgiven. And then if there are any students who are in their last year of school that are going into healthcare, you may get up to $120,000 of your student loans forgiven. These options are available to people who decide to serve underserved populations. So if the nature of the work that you do is helping a population that typically doesn't get the best quality resources, you might be eligible for some type of student loan forgiveness. Because typically when you're working in these areas, you are not making a gigantic amount of money. And so in order to help alleviate the expenses that are coming from the education you received to do the work that you're doing in this area, you qualify for different types of forgiveness. So in addition to the forgiveness options, there are different types of repayment options that might be available to you. And so many of these options are income driven, or different types of income repayment options. And so I'm going to talk through the 5 different options that are for federal loans. So a lot of this information I'm talking about is for federal loans. If you have private loans, I'm sorry, there aren't very many forgiveness programs or options for you. That's something you have to work out directly with the financial institution that you took the loan out with. So the first one I'm going to talk about is the income-based repayment option. And so what this does is it adjusts your monthly payment based on your income. Now, typically when we enter repayment for our student loans, we're automatically put into a 10-year default repayment plan. And what it does, it just divides it, and you got 10 years of payments. And sometimes it's like crazy high, because if you have a 6-figure balance, then you might end up $900, $800 payments a month, and you might not be able to afford that, and many people cannot. And so that's why there are these income-driven repayment options. So the income-based option, how this works, it is calculated based on your adjusted gross income. So think about the amount you make before taxes. That amount You subtract 150% of the state poverty line based on the number of people in your family. So for example, let's say Virginia's poverty line for a family of 2 is about $17,000. And so 150% of that is somewhere around $25,000. So you would subtract the amount you make. So let's say that's $40,000. $40,000 minus about $25,000 is about $15,000, right? And so that's what the federal program is going to consider your discretionary income, $15,000 of discretionary income. So that $15,000 divided over 12 months, 10% of that is going to be used to calculate what your monthly payment would be. So 10 to 15%. And so that number would fall around somewhere between $100, $150, $200, which if you were on track to pay a $900 payment, this income-based program would be a much more feasible route for you to take, where you could actually make the payments, not get behind, and impact your credit score. So if you have very, very high student loan payments that you cannot afford, take a moment, contact whoever your service provider is, and get on an income-based program. Another type of income-driven program is pay-as-you-earn. So this one was created in 2012. This one, it is similar to the income based. What it does is 10% of your discretionary income, again, same calculation, with your AGI, subtracting the poverty line of whatever state you're in based on the number of members in your family. With the pay as you earn program, your loan is forgiven after 20 years of payment. So that's another benefit of the payment programs. You could potentially qualify for payment forgiveness. Now, there are some pros and cons to these, and we'll talk about those in a minute. But the thing to know about these different programs is that it's all based on how much income you have coming in and the poverty line of the state that you're in. And so it's going to vary what your payment will be. And as you earn more money, the amounts could increase, things like that. Most of these repayment options, your monthly payments could be lower and manageable so that you actually can make the payments. You could then become qualified for loan forgiveness that you weren't qualified before just because you're in one of these repayment options. So with these different repayment options, typically there are 20 to 25 year programs. And so if you are somebody that has like $150,000 of debt and you know you're only making $40,000, $50,000, this could be a way for a sizable amount of your student loans to be forgiven just by making these minimum payments. Now, you can also maximize the benefits of any of the public service loan programs that you have. So you get on the income-driven repayment options, then you're in a public service position. So not only are your payments lower, you're able to take advantage of being able to remove your debt after 10 years of service. So instead of, having to wait the entire period of the 20 to 25 years in one of the income-driven programs, if you're in a public service position, you do your 10 years in the income-driven program and then apply or finish out your program with the public service forgiveness program. And so you do have to apply for the public service. They're not just going to automatically forgive it. There's some paperwork involved, but this is a way to reduce how much you're paying back in student cons. So some of the things they don't talk about when you do a income-driven repayment plan is it could cost you more over the long term. It's because you are decreasing the payments and spreading out the loan term so that you might be paying more in interest. And so what went from being a 10-year repayment plan now is a 20 or 25-year repayment plan. And if you don't qualify for public loan service forgiveness, then that might end up costing you more money because you decreased the payments to make it more affordable in the short term. So one of the cons is it could cost you more in interest payments. Another con, and this one is really something to take into consideration. Once your student loans are forgiven, the amount that is forgiven is now taxed as income. And so if you have, $50,000, $60,000 forgiven, you're going to get a tax bill for however that amount is at whatever bracket that puts you in. So this is something to think about. Now, some other things to talk about. Should I accelerate my payments and pay off my student loans faster, right? A lot of people are talking about being debt free, and there's different opportunities to invest and things like that. We don't want to have debt hanging over our heads forever. Some people go with the idea, well, I'm going to have these student loans till I die, so whatever I have to do, defer. So when we're talking about if we should pay off student loans or any debt really early, the bottom line is doing the math. And so when I say do the math, I want you to think about the opportunity cost. So the amount of money that I'm spending paying extra towards my student loans, what else could I be doing differently with that money? If my student loans have a very low interest rate, let's say, it's 3, 4, maybe even 5%, and the extra money that I'm putting towards it could be invested at 6, 7, 8% at a higher interest rate. Does it make more sense to accelerate paying off that debt, or does it make more sense to invest where I could be getting a higher return? Everything boils down to the math, right? Some people, they want to be debt free because there's this freedom with not having to pay any debts. And if there's an emotional connection for you and it's going to free you and make you feel better about your finances, then by all means, ignore the math. And if you want to accelerate your payments, do it. But if you're trying to make a decision based on return on your investment, then you'll want to consider, okay, where is this money going to get the best bang for my buck? Does it make more sense to invest now and allow my money to compound? Or does it make more sense to pay off the debt so that the interest on that debt doesn't compound? So we have to do some math and we have to run some numbers. So you'll need to take into consideration, what are the interest rates on the things that I'm trying to pay off? What are the interest rates on the things that I want to invest in? And see where the best investment is of that money. Paying off your debt is an investment too. So think about the math when you're trying to consider, should I pay this off faster? Do I even need to be aggressive with it? Because if you're in a loan forgiveness program and you know that you're not going to have to pay the full amount off, it doesn't make sense to make additional payments to try to pay it off if you won't have to pay the whole balance. So you want to exhaust all of your options first before thinking about, okay, let me throw some extra money at this thing, which is why it's important to have some type of plan in place so that you know what the numbers look like.